What's going on, guys? Welcome back to another episode here on Let It Grow Investing. And I'm going to try this one without the background on because it failed me miserably last time. And I had a complete botched episode and we missed quite a bit of that middle segment of the last one. So here we go. We're going to try it without that. We're going to try to make this one better. And hopefully we got an improvement here on this episode. So thank you guys for being here. Make sure you like, subscribe, and share. It definitely does help the podcast grow. And hopefully I can help your investments grow as well. So yeah, a lot of different things going on. I know we say that all the time, but there's always just so much small news and nuance to cover that, it always makes the market go crazy. So what happened this past week? What happened going forward? What are we watching? And there's a lot of different things. So in this one, we're going to be talking about a couple key different points here. PCE, the labor market, we're going to be looking at the de minimis tariffs that just ended or duties. Retail sales, we're going to be looking at Nvidia. I'll probably take a look at CrowdStrike. And then I want to take a look at what a 37-year-old business owner question that we had here. I want to take a look at all those things. So first up, we're going to roll right in. We're going to be looking at the higher core inflation from the PCE, which is the Fed's preferred measure here, right? So we're going to be looking at higher core inflation. I'm going to pull this one up, right? So we've got higher numbers coming out. We've got today's inline PCE price index will keep the focus on jobs market for now. So it was 2.9%. These are the personal consumption expenditures, the index on a core basis, right? So it excludes volatile food and energy, 2.9% increase from a year earlier. Normally speaking, this just shows that we have higher inflation. People are paying more for all the different items are out there. So if we are cutting rates, generally speaking, people are going to buy more, which is going to have inflation go up higher. But we are also looking at a labor market that I think I had this one pulled up, but I don't see it right now. So we know from a couple episodes back that in the labor market, we were actually seeing less jobs added than what we were expecting. So kind of a split situation here where some expenditures are going higher, but the labor market is weakening. So it looks like the Fed is probably going to stay on course, have to keep that rate cut at that September meeting. That is what we are thinking. We are not too sure, but this PCE came out on Friday, and that did send the market lower, right? So we were looking at a market that did trade down on Friday. Here's the S&P, right? We were at 64.60 at the close of the day. Again, overall for the month, we were up, right? So we're looking at a market that came down minimally, right? So we gave a little bit back, nothing crazy. And even on the 5-day, we're up, but we are not up as much as we might have been on Thursday. So a lot of things here to really think about, right? Where is this market going? What does this ultimately mean? What do Nvidia's earnings have to do with this? What does retail look like, right? If a lot of these different retailers are saying that they're slowing demand, I think I was looking at an article from Walmart saying that a lot of demand was actually down. So I'm probably going to have a hard time finding it right now because I did not actually bookmark this one. But a lot of people saying that the actual spending, they're concerned about it. So we've got to take that into consideration. Now, in the next breath, we have the de minimis exemption, right? Exemption? Yeah, de minimis exemption. I'm going to pull this one up now. We're going to be hopping all around. Keep up, right? So retail panic. What the end of the de minimis exemption means for brands across the globe. Basically, long story short, if you were importing something under $200 or then $800, I believe the exemption was raised to in around 2014 or 2015, you did not pay duties on importing those goods into the country, right? It was almost like it was too small to care, wasn't a big deal. So your larger companies had paying these duties on cases of goods. But if it was just one company going direct to consumer, they were not paying the duties. So then their prices can be cheaper. They can go direct to consumer, cut out the store, cut out the duties and the tariffs or taxes on all these goods, right? So you're looking at Shein, you're looking at Temu, you're looking at Etsy, eBay, Shopify, right? All of these companies that are importing small goods and going direct to consumer, not paying these fees. So they are able to make more money They cut out that middleman. They cut out the brick and mortar. They cut out a lot of different steps, and they're not paying those fees, right? Essentially. So we thought we were going to have to the end of July of 27, and roughly 2 more years of this type of playing field. But then Trump comes out and says, "Hey, we're going to end this," right? So this was went into effect on Friday. So another thing on Friday that kind of shook the market up. What does this mean? Ultimately, it's bad for the small guys that were doing this. For your Etsy, eBay, Shopify people, which might be American-based, but they're importing goods from abroad. Also, it's going to be hurting the Sheins, the Temu, the AliExpress. Maybe if they're going direct to consumer, I'm not too sure how that one works. But it's going to hurt them because their fees are going to be higher. They're going to have to sell their goods for more in order to make the same amount of margin. So that should essentially level the playing field for some of the people that are paying these duties, which either way, it means that us as consumers are paying more for goods. But I think Forever 21, when they filed for bankruptcy earlier this year, they said the de minimis exemption is really hurting them. Shein and other companies like that are going ahead and basically charging even less than what they're capable of doing by going direct to consumer and not paying the fees on the goods that they import. So we are trying to protect a little bit of American business. We're trying to protect some of the bigger companies. We're trying to protect those that aren't going direct to consumer from abroad, which is, it's kind of a mixed bag, right? On one side, we're paying more for goods. On the other side, we're trying to keep jobs in place. So it's kind of a split decision. I'm sure there's going to be some people that are really upset with this. If you are selling on Etsy, eBay, Shopify, it's going to affect your business if you're importing from abroad. But if you are, a manager of a Macy's or somewhere like that, hey, you're thinking, man, this gives us a chance to survive. This gives us, a fighting leg up on some of the competition out there. And we will ultimately see what this means for larger business that has those brick and mortar stores that are importing in mass quantities rather than just simply selling, $200 or $400 worth of goods direct to consumer. I mean, $800 at Shein is wardrobes for a small village, looking at some of those prices that are on there. So that is interesting. We will see what happens there. But another reason that the market was shaken up on Friday, right? So we had PCE. We had the de minimis exemption going away. We had a little bit of NVIDIA. That was more Wednesday, right? I did want to cover this one. We're going to take a look over here. I'll take a look at this one first. It's a kind of a Jim Cramer write-up on what happened there. But yes, there was some jitteriness when it comes to NVIDIA. They did miss in one segment that is kind of a critical area. I don't know that that's what really shook up NVIDIA stock, but it did have some effects on it, right? So they did not close higher, lost more than 2% on Friday after Chinese technology giant Alibaba unveiled their AI chips. Huge announcement, right? So we're trying to see if Alibaba actually has some kind of staying power here. Some people saying it's a great stock to invest in. I drank that Kool-Aid years ago, and it did not do well for me. So I am not buying in any Chinese companies. I don't think that they play fair, and I don't think that it is going to be the growth driver that a lot of people think it is. We've seen this roll out far too many times. We've got Alibaba rolling out their chips. We're trying to see if NVIDIA is going to be able to sell in China, which is, really a unknown that really is shaking up that market. Some people saying they disappointed because they did have something in for China and there was nothing in for China. This is just Kramer's words. So we had a lot there to really digest, right? We got to know what happens with China, what happens with NVIDIA, AMD. Can we sell there? Can we not? What can we sell there? Are Alibaba's chips better than what we are currently able to sell from NVIDIA, from AMD? They are doing a $60 billion stock repurchase, I believe. Don't quote me on that. Let's take a look at this one. NVIDIA stock falls after data center sales miss forecast. It was 41.2 billion versus 41.1 billion actual, right? So that doesn't sound like a lot. It's just a little decimal point, but that does show about $100 million worth of miss there. So we've got that. We've got there is a repurchased somewhere. Oh, sorry, 41.3, and it was 41.1. So it was 200 million. Notice that approximately 50% of its data center revenue came from large cloud service providers, which I believe was majority was 3 companies. Fell about 2%. So is this a point where we want to buy this stock? That is going to be the question that a lot of people have to ask. Or is it time to get out? Are there too many fears going forward? Well, that really depends on what you think, right? I still think that AI does have a potential to triple, like a lot of people say, in the next 5 or even 7, 10 years. Then we think, hey, what else does Nvidia do? Right? They're in a lot of those spaces. They're in a lot of high end computing, graphics. They're in blockchain with Bitcoin mining and things like that people kind of forget about. We're still looking at robotics. Can they make some of the best robots, the chips that are out there? There's a lot of different things that NVIDIA is going to turn to if it's not just strictly AI chips. So I do believe that there is still a lot of growth that could be had in this space. And it's not simply just, we're only concerned about AI. We're only concerned about China. I still think that there is a lot of growth that could come from this company. So I did see that we are looking, something was about data center was at 50%, and then it could grow 50% year over year from there. This was large service providers. There was a stock buyback, right? 60 billion right here, 60 billion in stock buybacks, up 35% year to date and 40% over the last 12 months. Yes, they did hit 4 trillion. We knew that, right? So we've got data center fell short, right? So we're slightly short. We're still moving up. I don't know if that's to do with a little bit of, scared reaction to the market. I'm not too sure why they missed. I don't think it's a production problem. But they did have a little bit of a miss there. They did guide better. They did have that stock buyback. They got a lot of things going for them. I still think China is the one unknown that is really going to be, make or break as to whether or not they get the growth that they really could have. It's not like they're trying to sell to Cambodia or some small country that's not doing a lot. The China market is absolutely massive. So if they can get there and sell product there that really competes with what we are able to produce, man, I think they are off to the races. So for me, I did buy a couple shares. I was trying to build back this position after that covered call that I've told you guys about probably ad nauseum. So I did buy a couple more shares, nothing crazy. But CrowdStrike, I don't have anything pulled up on CrowdStrike, but let's go through this one real quick. We'll see what we got right here. We'll see CrowdStrike earnings, and we'll go from there. No, I don't think that it went too hateful. Adjusted earnings, 93 cents per share, beating the consensus of 83 cents per share. So that's awesome. Revenue, 1.17 billion, a 21% increase year over year, and above forecasts of 1.15. Annual recurring revenue grew to 4.6 billion with 220 million in net new annual recurring revenue added during the quarter. So the more people they sign up, the more people that are on the platform and have recurring revenue is really one of the benchmarks here for a subscription-based model type company like CrowdStrike, right? The more that they can bill yearly to have these people on their product, the better, right? So once they get on, it's hard to get off. And the quicker they can grow this ARR is going to be a better thing. So CrowdStrike projected lower than expected revenue guidance of 1.21 to 1.22 versus Wall Street's 1.23. So that outlook is a little bit light. Caused the stock to dip in extended trading following the report. I did buy more of this on Thursday. So I will say that. What else do we have? We talked PCE, labor, de minimis, retail, NVIDIA, CrowdStrike. Now, I did see, and I'll stop sharing for this one. I'll just go right to you guys. I did see a situation on one of these groups where it was a 37-year-old business owner that had been spending all of his money building his company, right? And I've been in this situation. I started investing when I was probably about 10 years ago. So I was about 28. And I had been funding my own company, buying equipment and trying to make everything work. Now, this guy had, probably had a different of a situation. And he's finally at the point where he's hiring employees. but he has not yet funded anything for his retirement. So one, do you let the business keep growing? Depending on the business, what's it worth? What can you sell it for at your retirement? Do you want to go about it that way? Do you want to fund an IRA, a 401k, a brokerage? What do you want to do here, right? And so he's looking for, some insight as to what other people might do, what other business owners might have done in this situation. And there's all different types, right? There's people saying start an IRA, start a Roth, start a SEP, and then backdoor to a Roth. A lot of different things, a lot of different plays. Some of them make sense, some of them don't. Someone said, more or less sit on your cash, wait for the next real estate collapse and start buying properties, right? But I have a problem with that. The problem that I have is we don't know when that might be, right? We kind of can assume with the stock market every, 9 months, we're going to get some sort of buying opportunity where you want to put your money into the market. We don't know really when that's going to be for real estate. So someone telling him to wait potentially an unknown amount of time in order to start investing, it could be 10 years, right? I mean, maybe not, maybe. I mean, there's a lot of things that say that could slow down sooner, but then housing is not as readily available. We're in a shortage of homes compared to the people that want to buy them. So even if we do get some sort of slowdown, are there going to be a lot of buyers coming out of the woodwork to do exactly what this other person is telling him to do? I think that's a potential problem, right? So how long do you want to wait? Does he want to wait until he's potentially 45, 47? Order to buy a rental or an income property? I don't see that making any sense. So for me, one, I would tell you to get a financial advisor if you're in a spot where you've got a lot of cash and you really don't know what to do with it. But even at that financial advisor might not really see what you see in the market, might not have your risk really taken into consideration, or might not really vibe well with you. So you got to do what works best for you. Find an advisor that really listens to you. Find someone that wants to start getting your investments rolling at the risk that you're willing to take, right? If you're not a very risky person outside of your business, maybe you want it in bonds. Maybe you're, depending on age, maybe you want it in something a little bit riskier. So you got to think, well, yeah, I want this, but I also want to, I want to plan for a vacation home. I want to plan for, an early retirement or whatever that might be. You've got to do exactly that to meet your needs. So a lot of different things to take into consideration there. A lot of different things that I'm not too sure simply just work for a one size fits all. I would never tell anyone to wait an undetermined amount of time in order to buy in real estate. I'm not a professional, but I just see that as a bad way to park your money until potentially we get this turned down. So for me, if I were starting all over, I would start with an ETF. I would start with a broad market ETF that covers multiple stocks in one basket, something like a VOO. And I will go ahead and share this real quick. Let's go ahead and get back to the numbers, back to the stocks here. We're going to take a look. VOO, we've got Vanguard S&P 500 ETF. We've got this portfolio, right? So when you're buying an ETF, you're buying a basket of stocks basically rolled into all one fund, right? So we're looking at buying a $593 share of VOO. Well, first off, what's the performance look like over the past 10 years? I think that is going to be the metric that they show us here. So if we would have put $10,000 in back in 2015, that 10 grand would have grown into 38,000. So if you had 100 grand sitting, it would have been 380,000. So pretty awesome return over that course of 10 years. Is there better? Is there worse? Certainly, right? But this is going to track the S&P 500, which is, pretty much tried and true, solid return over the course of time, right? So this is your growth percentages here, right? So this is higher than normal, but it could slow down. We could see some periods where it doesn't grow like this, but on average, we're looking 9-10%. So pretty awesome returns for parked money, right? Better than sitting on potentially $100,000 for 10 years and not seeing any gains, right? If we don't invest it into real estate and we had $100,000 and we didn't park it here, we would have lost money towards inflation, right? But if we would have parked it here, we would have seen almost a 4x growth in that same point of time. So doing something like this, buying into a portfolio like VOO or any other broad S&P 500 ETF would have seen multiple, multipliers over that course of like that 10 years. So if we're looking at, what is this going to be invested in? We're looking at Nvidia, Microsoft, Apple, Amazon, Meta, Broadcom, Google, Berkshire, and Tesla, right? And I should have said Alphabet because that's what it says here, but I'm just, I guess, used to saying the G word. So we've got that, right? So now you invest that, you tuck some money away there. Great. That's a great way to start. Now, if you want to get into single stock exposure, you can certainly buy some of your favorites, do some more homework, sharpen that pencil, and really see where you want to park that cash. But this is a great way to start. And, you can kind of broaden out from there. Do you want more dividends? Do you want more growth? Do you want more safety? You can take a look at different stocks that really meet those needs for you, right? You can take a look at the beta of an actual stock. The closer it is to one, the less volatile it is. And then if you look at something like a Tesla, it's going to be higher on that beta metric. So you're looking at Tesla, it's a 2.3 versus Coca-Cola should be much lower, right? If I just going off the top of my head, right? So beta of 0.1 on Coca-Cola, less volatile. Bad for options, good for, kind of sustained growth. Some of these stocks that are going to be more in that growth category. Let's take a look at what Nvidia does. It's a 1.8, so less risky or less volatile than what a Tesla is, but a lot more volatile than what a Coca-Cola is, right? So we can kind of see by that number where we might want to be when it comes to your investing style. If you want more dividends, you can look at a ticker like Noble, which is going to be a dividend aristocrats, those companies that have been paying rising dividends for 25 or 50 plus years. We can look at those, right? So now, Walgreens wouldn't be in here anymore. That one had been paying a dividend for a long time, but they have gone private. I forgot to mention that a while back, and I did want to bring that up. But this list has, Cat, Emerson, Franklin, Nucor, C.H. Robinson. So we got General Dynamics, S&P Global, T. Rowe, Pentair. So there's a lot of different dividend stocks that are going to be paying us more going forward, right? So a lot of different things that we can get into these. We're looking at a dividend of roughly 2%, give or take, maybe a little bit less, maybe a little bit, 1.3. So this would be, I would probably be looking to buy this at more like a 2% dividend yield, but you can certainly start a position here at 1.3. So it really depends on what your risk tolerance is, what you have this money earmarked for. If you're trying to retire on this and have dividends pay you, maybe you want some stocks that are paying more like a 4% yield, maybe 5 or 6. Just really depends on the growth that you want and where you want to park your money. So is it simply just wait until that next market downturn to buy? No, I don't think so. I think if you were going to buy something like a VOO, I would be looking to maybe average in, say you had that 100 grand, right? Say, you had this business that's really been doing well and you wanted to get in. Maybe you put in $25,000 now, maybe you put in $25,000 6 months from now, another 25 in a year. And then, that final 25 grand in 18 months, right? So now you're leveraging out your buys. You're buying on some of those dips. Granted, you could do it monthly, right? You could do $5,000 monthly until you're out of cash. You could, do whatever makes sense to you, makes sense for your financial situation. Your tax advisor might tell you something as to how much you need to invest or where you could put it, where you could park it in order to make the most sense for your individual situation. So just some thoughts here that I had, and I don't like these blanket statements of I need to throw money into this individual asset or wait this certain amount of time or try to time the market perfectly or anything else. So that is what I'm thinking here when it comes to where to park money, how to get started, and really where you might want to go, how to ladder out some of these buys into a fund that really might make sense for you. Or, hey, maybe you just go say, I don't even want to think about it. I just want to buy it now and park the cash and I'm along on the run, right? So I'm 30, this person was 37. Say I want to retire at 55. I'm just throwing it all in. I'm not going to look until I'm 55. Some people are like that. I'm not one of them. I check multiple times a day, but I know there are plenty of people out there that simply just purchase once and then, they add when they have more cash. So with that being said, what are we looking to buy? Last week, we were looking at buying more Lily. That did pretty well, right? We were looking at this one sub 700. We did buy on Monday. If I look at this chart, can we take a look here and see exactly where we were? I think we bought maybe it was right around that 710 or something like that. This is what chart? 6 month. That isn't going to work. Well, let's look at the 5-day. We were probably buying somewhere around here on Friday or on Monday, which looks like it was 721, but I feel like I got a better purchase price than that. Anyhow, it's up to 732. This one has been doing okay after orforglipron's trial. Did not meet the end result of the injectable, but it is increasing now. So if we bought on some of those dips down into the mid sixes, congratulations. You are up probably $80 a share at this point. Do we want to take a look at something like an Nvidia? The fact that now we do have earnings out, it's a little bit under where it was beginning of the week. Is this a time where we want to take a look from 182 down to 174? Does Nvidia make sense? Well, there is some risk. I think long term, I think we're fine. We got around 20% of upside from the analysts. Tesla, still downside there, I'm sure. Meta, I do like Meta a lot. They have had a massive run this year as well. I think we did hit into the fours even earlier this year. I thought maybe we could hit 8 by the end of the year. We did have this thing come crashing down along with Nvidia. Maybe not crashing, but trending down after Wednesday's earnings reports. We did see this kind of come back down. We're going to pass on Lily right now. It is moving up nicely, but I don't want to keep adding into that. Next era. Let's see what kind of upside we have here. 19. That does not look bad for a utility company. I like that. CrowdStrike, a little bit of a miss there, but not doing too poorly. I did buy some for myself. I might lay low on that one. I'm kind of thinking next era with that kind of upside. Costco might have some little bit of shakiness when it comes to tariffs and the amount of people that are doing trying to ship things in beforehand and what's going on there. Oh man, that's a nice amount of upside. I really do like Costco. I think that they're going to do really well through all this. Downside is limited. Bank of America, if rates come down, that starts to make more sense for me as well. Upside's not really there. Downside is limited. AMD, similar prospects to what Nvidia looks like. Nvidia's got a little bit more upside. However, I think I'm going to go with next era on this one, guys. I think that makes sense. One, everyone's got to have utilities. We have so much demand on the grid. The fact that we're getting around 19%, very, very little downside here. How have they been doing recently? We did come down from 86, but that's back in October. Let's take a look at like a 1 month chart and maybe a 3 month. That might give us a better picture of where we've been. We have a cross above this 200-day. That is a bullish sign. We did trend up to 76 and down to 72. So as long as we can stay above some of these other lows here, which is even at 70, 50, I think this is a pretty safe buy. This is generally a good crossover where this 50-day moves up above this 200-day moving average. So when we see the 50-day trend through the 200, and now we did get this quick bump up, and now we're coming back down. I'm hoping it can kind of hold this line around 72. So I think that's where I'm going to put this $200 this week for the investing challenge is in ticker NEE. And we will see what happens there. We do get a decent dividend when it comes to next era. What is the dividend here? 3.14. So outdoing the S&P 500, outdoing Noble. Granted, probably one of the higher dividend payers on this list. Yeah, for sure. For sure on this list, the stocks we were looking at for this year. The only other one might be Bank of America. That's a 2.2. So next era is going to be the high dividend yielder on this list of 12 stocks that we were looking to buy for 2025. If you're following along, I do add $200 worth of individual stock that we discuss here on the show into a Webull portfolio. If you need help getting started, there are some offers on this Labor Day for starting a new account and getting it funded, and then you get some free shares doing exactly that. So feel free to use my link. It's in the description. Please make sure you like, subscribe, and share. It definitely does help the algorithms and get us seen to other like-minded investors. So thank you very much for stopping by. Please make sure you're following along, and I definitely appreciate the support. Thank you guys very much, and I will catch you in the next one. Take care.